Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and analyze the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the four major market indices, we'll also take a quick look at the U.S. dollar. We'll see how it's affecting oil, gold, silver, and also how Bitcoin and Ethereum are behaving. We're having some pretty big fluctuations right now in that space, but we'll get into that a little bit later on today. If anyone in here has a chart they want me to look at, feel free to type it into the chat, even now, even if it's a little bit ahead of time, just so I have an idea of what I'm looking for and how much time to allot towards chart requests. If you like what you see here, you can always follow me at Stock Darts on Twitter for more information and more content from me. You can find these videos on YouTube under the same name, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, as well as the reposts of these Wednesday market reviews as well. And that's typically the best place to go if you like the way I trade and want to look at more of my trade ideas and more of just the way I generally approach trading. Other than that, let's go ahead and get started. The first thing we're going to do is take a look at the S&P 500, and we're going to do so through the ETF SPY. And as you can see, zoomed out, we're still in a very strong uptrend, and the market is still in a pretty healthy state, particularly if you're looking at the S&P 500, where you can see that we have a very clear channel that has yet to really be breached or really broken by the sellers. We are in the beginning of another potential consolidation / pullback range. You can see, and I'll zoom in a second, you can see we're down about 3 or 4 days in a row. However, we are still right next to all-time highs and just beneath them, and so it's hard to get overly negative or overly bearish even in the short term with the type of pattern that we're seeing here, at least in the S&P 500. I think we'll see a little bit of a different picture as we move across the four major market indices, but if we're looking at just the S&P 500, which I found to be probably the most general representation of the overall markets, I feel like it's the good average, quote unquote, as far as the four indices are combined. And as you can see, it's still pretty positive. Now, we are coming into a potential point here where there will be a battle between the bears and the bulls to decide whether we are finally ready to break this clear uptrend that we've had for so long, or whether we're just going to continue right along these train tracks and just keep climbing higher. As I zoom in, you'll see a little bit more clearly what we're talking about. You can see that on Friday last week, we kind of printed new highs and we kind of stalled out, and then this week so far it's just been, or actually sorry, that was Thursday and Friday because Monday was a non-trading day, and this week so far with yesterday and today, we've just kind of pulled back and kind of built upon that little red candle that we printed on Friday of last week. And so at the moment this is still bullish. All we're really doing is we had a breakout, and we're just coming back and retesting that breakout and just making sure that the bulls are still in agreement, or buyers are still in agreement as to our new price range, and this resistance should flip to support. So this is still very, very nice, and I don't think at this point we have enough data to support the idea that we're ready to kind of pull back. At least, like I said, not on the S&P 500, not looking at the ETF SPY. Typically in these sorts of patterns, what happens next is we test the 20-day. We test the bottom of this channel. We test this previous level of support that was resistance that should flip to support. And so we've got three underlying technical indicators that all are suggesting buyers will come in and support price here. And so we're going to have a real acceleration in selling pressure in order to push through all of those levels. And if we do so, we still have the 50-day moving average kind of coming underneath price that will also end up supporting. So I don't think that we have a major trend shift coming in the near future. I think that we will be testing these levels of support, and 1 or 2 or even 3 of them may be broken. But generally speaking, I am not looking for a reversal of the trend here. I'm just looking for a potential test of it and then see how the market responds to that and what we want to do next. Now, like I said, with the S&P 500, these patterns suggest that buyers will step in and will defend it, and we will get another attempt back at all-time highs. However, we want to be prepared just in case that doesn't happen, right? And so what we want to do is figure out our plan of attack. If one, the buyers do step up and appear, what do we want to do? And two, if the buyers don't and the sellers take control of the price action in the short term, well, where do we look to go ahead and look for the buyers to kind of come right back in, right? And so that's typically what you want to do is you don't want to tell yourself, well, we're going to bounce and just marry yourself to that idea. You want to outline the two possible scenarios or three possible scenarios that could take place and how you'll react when you get to that point. That way you're not caught up in emotions if something drastic happens or if something changes in the market and you weren't really anticipating it, or it's not exactly the scenario that you thought was going to happen, right? So the most likely scenario, like I said, is that we test the 20, maybe even dip a little bit below it, test the bottom of that channel, test this 446 level, and very likely we will find support and we will try to bounce again. So if you're looking for that, what you want to do at this point is maybe draw a trend line here. Maybe just kind of watch the candle pattern and see what happens. But you want to wait for a reversal, and you want to see green candles show that the bulls have showed up, whether it be today or tomorrow, whether it be in another 2 days, whether it be on Monday of next week, once we really challenge these levels below us. Now, what happens? What happens if the bulls lose control of this and the bears are able to push the price action below the 20, below 445, and possibly even outside of this channel? Well, we still have the 50-day moving average just underneath, and I suspect that what would end up happening at that point is that the price action will kind of chop back and forth between the 20 and the 50. So likely what will happen is we come back, we test the 50, buyers will probably step up temporarily and push the price action back to the 20. And then from there, it could be that we roll right back over and head lower, or it could be that we've had enough of a shakeout to try to go ahead and break out further. Those of you that were here last week, you'll notice, and even the last couple weeks that we've had these Wednesday market streams, I've pointed out a pattern that's kind of been in play for a while now, where before every strong rally that we've had this year, we've had a little bit of a shakeout where the markets kind of quickly head down and test prior support and then eventually break out. You can see it happen here in August, it happened back here in July, it even happened here in June, and it even kind of happened here back in May, and if I go further back, you'll see it's been happening all the way since January. So it could be that we're going to need to have another big shakeout, and then it turns out that we just kind of run off back to the races and possibly abandon this channel, but not the bull market. So you want to keep that in mind. However, if we do come back and test the 50 and buyers are still not really ready to support it, well, the next level of support is just below it, right around 440. And that is probably going to be a good level as far as looking at a defensible area to buy the dip and looking for a potential, a decent sized correction, and yet still be pretty excited about entering a dip and a kind of counter trend play. Now, if we do head back to that level, there will be some bigger fluctuations in play here that could change the way we want to approach our trading, because you'll notice if that happens, the S&P 500 is going to be outside of this channel that is basically held since November of last year, right? So that is going to be kind of a big indicator that maybe we are changing our market dynamic and our market environment. Now, if that's the case, I still think that it's going to be initially met with buyers, but it could be that we bounce, retest this area that we would have failed from, and then head lower. And I think that a much stronger and bigger level to look at as far as entering buy the dip plays, particularly if you're looking to scale into longer term holdings, would be somewhere around this 422 area. Now, do I expect us to hit 422 from here to next Wednesday? No, not really. I think if that were to happen, that would be a major shift in market sentiment, at which point we would really have to kind of step back and really analyze how we want to go ahead and reshift our stance. But it could be something that we hit at the end of this month or even October, depending on how we go ahead and navigate this test of support that's incoming on the S&P 500. But in the short term, more likely than not, we are going to test the 50 or the 20 and see how we bounce from there. And depending on how we bounce from there, that will dictate what happens next. Like I said, if we break this downtrend that's kind of just developed over the last 4 days, then it's off to the races and we're back in the channel and we're just going to go ahead and kind of drift higher and see what happens next. Now, the other pattern that has kind of played out over the course of this year has been, despite the fact that we stay in these channels, we have these decent areas of consolidation and sideways price action. And it could be that we are just starting to really develop a new rectangle. Now, we don't have a lot of room to the side without losing this channel, but it could be that we just break that channel, and what we end up doing is something along this nature. And I think this could be one of the more likely scenarios, possibly even more likely than us just breaking right back out and heading to new highs, is that we do lose the channel, but maybe we hold at the 50 and we come back up and we test the 20, then we come down and we kind of just go back and forth and develop another stair step, and maybe just this trajectory doesn't hold any further, but it doesn't mean that the bull market is dead. And as we move on to the NASDAQ, you'll see that just because you lose one of these upwardly trending channels doesn't mean that the trend is dead. It just means that that particular channel or that particular shape of that trend dies down. And so we'll get to that in a second with the NASDAQ. But basically with the S&P 500, we have a couple of key levels of support just below us, 446, and I would say not even really worry about 438 right now. Really worry about the 50-day moving average. Those are the two key areas to watch to see how it's defended by the bulls. And then above us, all-time highs at 454, which I imagine if we find buyers at the 20, we'll break through to new all-time highs again and just keep drifting higher. And so those are the key points that I'm watching as far as trying to structure my trading opportunities and what kind of charts I'm looking at over the next couple of weeks or so, at least until we see what happens here. We have a major test coming in the next couple of weeks, and we should have a lot more clarity as to what the bull market wants to do next, depending on how we navigate through this confluence of potential support that's really starting to build up right underneath where we are, and a market that's maybe looking a little bit tired. Now, if we look at the NASDAQ, you'll notice something a little bit different, right? And so we've only pulled back a little bit today, right? So tech is still kind of strong. I alluded to it last week that tech was, and actually the last few weeks, that tech was really starting to build momentum again. And despite the fact that it was already breaking out, I still felt that there was more momentum left in tech names. Now, they haven't really rallied further beyond these all-time highs, but as you can see, even yesterday we printed new all-time highs. Even if it was just nominal, it was just kind of peaking up above the previous highs. And we're starting to see a little bit of selling pressure today, but overall, tech has held a little bit better than the rest of the overall markets. Now, that could continue into the next couple of weeks, or it could be that we will see some profit taking here. One of the big keys to making money this year in particular has been trying to catch the seesaw action as money rotates in and out of tech and recovery names. As there has been a lot of bouncing around between different areas of the market, while the markets just generally climb higher. There have been periods where the tech sector, as you can see what happened back here in April and May, where the tech sector really struggled while the overall markets kind of rallied. And there's been other times where the tech sector starts to lead the way back higher as the other markets start to slow down a little bit. And so that has been one of the real keys, is try to figure out exactly when to get in and out of tech and when to go ahead and take advantage of this momentum. I think that we are not ready to get out of tech yet. I do think tech is going to pull back. I think just like the S&P 500 and the Dow, we need to come back and test some lower support levels. The big key difference here is we're not at a spot here where breaking or coming back and testing support breaks whatever our previous channel looks like or whatever our previous trend looks like. So if you look again with the S&P 500, if we start to pull back a little bit further, well, we have a major trend pattern that will start to break and will be invalidated. We're not with the NASDAQ. That's not really true. We can pull back for quite a bit with the NASDAQ, and still the previous trend and the previous market environment is still going to hold true. As long as we hold above 368, well, the NASDAQ is still technically in the same kind of pattern that it's been in since we started to break out back in July. And so we're at a spot here where we can pull back and take it a little bit better and not really have to worry about readjusting our attitudes or our stance on the cues. Now, as I mentioned when we were looking at the S&P 500, part of the reason that this is the case is because the NASDAQ broke that channel a long time ago that started back in November of last year. And this is what I was saying as far as evidence suggesting that just because you break a channel doesn't mean that that trend is dead, or that the price market environment has shifted to the point where you need to be bearish. It's often going to happen that these channels can't sustain themselves indefinitely. Sooner or later they will break, and really that's when you start to see exactly how the bulls are going to go ahead and reinvest into it, or what's going to be the next shape that dictates how these price patterns play out. And more often than not, what ends up happening is you build out a base of accumulation, right? And then so what happened here was the Nasdaq built out a little base here, threatened a breakdown, but eventually found some buyers, and we came in and we started another base and another round of accumulation, and eventually that was enough to tip the scales where the buyers outnumbered the sellers, and that's when we finally had that breakout that happened in June and July as money started to rotate back into a tech sector that was sort of depressed and sort of lagging behind a lot of the Dow components and maybe even energy names as oil was ramping up at that time. And so now we've reached a spot where the Nasdaq is the leader again, but because they've already gone through these big kind of corrections, it's not quite as in danger of losing that trend like the S&P 500 is. And so it could be that the S&P 500 just needs to go through one of these phases. And so even if we break that channel on the SPY, I'm not looking at it as a major indictment on our bull market and maybe the beginning of a market top. I'm seeing it as just another broad consolidation range that is just a normal part of the way price action behaves. And so with the Nasdaq, we have room. We have room to drop and still be in a pretty bullish state, right? We can come all the way down to the 20, and that'll be a retest of this very short-term level. If we lose the 20, then we have a real strong retest here around 368, and I think this is going to be a key level to test. And it looks to me like the market, despite what we just saw on the S&P 500 and what we're seeing here in the Nasdaq, as we get to the Dow and IWM, you'll see that there are some patterns or some signs showing that there is selling pressure really coming into the markets at this time. And if that bleeds into the Nasdaq, there's a very good chance that we come back and we test this 370. And I think this is going to be the key level to really watch in the short term. I think from here to next week or the week after that, we don't fall below this. I don't think that we've seen enough catalysts or potential catalysts to really tell us that the markets are ready to correct in a very swift manner. I think more than anything what we're seeing right now is just a temporary fluctuation back and forth, and probably what we're going to see here is just a short-term pullback to retest support and to see exactly where buyers want to step right back in and try to re-enter this trend higher. And so, like I said, with the Nasdaq, I think the levels are very clear. Also, as you have a strong trend like this, typically the more important levels for the first pullbacks are the moving averages anyway, and the fact that these moving averages are going to coincide with both of these horizontal levels again leads us to believe, or leads me to believe, that they will likely hold as initial support. So we're probably going to pull back and test somewhere around 375, and that should be a spot for a temporary bounce. And if we end up seeing more selling pressure and we come back and test 368, that would be pretty close to the 50-day moving average and will likely be a strong source of buying support. Now, if for whatever reason we do get a very strong selling move in the markets, what would be my line in the sand where I really start to worry about the Nasdaq, or think that maybe it's time to really start to pull money out of the market? I think that a move down to 342 would be, while that would be a very massive move, I would consider this to be a very strong level of support. One that I would look at as probably a good spot to go ahead and potentially add long-term holdings. I'm still not overly concerned with us having our bull market turn into a bear market. I think with the current attitude of the Fed and the current attitude of just the way equities have been behaving, the way money has been behaving, I don't think that we are seeing an end to our bull market anytime soon. And so I am not particularly concerned with a major shift in our trend. However, there's room for us to fall from here to 343. This could wipe out trading accounts. So I'm not being complacent. I'm not saying just hold all your stuff and don't worry about a market correction. A move from 380 to 342 is going to hit a lot of people very hard and hit a lot of portfolios very hard, despite the fact that on the weekly chart and on any kind of a long-term chart, that is just a run-of-the-mill pullback within the context of a much larger and longer-term uptrend. As you can see, we have a lot of room that we could pull back and have a serious correction in the market and still not really dent the overall rally that we've seen just from here to the COVID drop that we had in 2020, let alone if we look and we scale further back and we really take a look at where the market has come in the last 8 to 10 years. There is a lot of room for strong pullbacks and strong corrections and even really market crashes, and still have this long-term uptrend be completely intact. So I think as far as my attitude is concerned with the markets, I'm not afraid of market pullbacks. That doesn't mean I want to see them. It doesn't mean they won't hurt me if they come. But I have a good enough risk management strategy where if we get these bigger pullbacks, I will be set up in a good place to go ahead and enter and take advantage of these opportunities to buy the dip. And so one major level that I would see in the short term or in the intermediate term would be 343 or so on the NASDAQ. And that would be a good spot if we happen to correct that much. Now, do I expect that at this point? Not really. Like I said, I think what we're looking at really are just fluctuations in the very near term and very close to our current price environment. So more likely than not, we just test the 20, maybe bounce. If we lose the 50, maybe we come up and we test 368. Very likely that we hold at least initially at that level. And then from there, you see how things play out. Now, it could be that we just continue to rally. And if that's the case, well, we'll just break today's highs or yesterday's highs over the next couple of days. We'll extend another leg up and then likely begin this process again of coming down and testing support. And so as far as the NASDAQ is concerned, what I'm waiting for is a pullback to the 20 or a 50 moving average, at which point I will be looking to scale into some trades on some tech names once they give me better opportunities to enter. Because again, I'm going to just real quick shoot through the FANG stocks, and you'll see what I mean about waiting for a pullback in order to get good entry. So with Facebook, this is a nice little bull flag. There is potential to play this as a momentum breakout once it breaks above 381, but more likely than not, as you can see, it's done a really good job of just respecting the 20 and more importantly the 50-day moving average. And so another pullback to the 50 is likely a good spot to go ahead and buy a bounce and maybe play right back up to the top, right? If you look at Amazon, Amazon has had a very nice move recently. This is one that I point out pretty regularly on my Patreon page, and we were looking at it as a potential buying opportunity as it was finding support around the 200-day moving average. This is a stock that I will almost always buy on any kind of a major dip. It is one of the names that I have the most confidence in as far as holding long term and even waiting for short term fluctuations. Now I understand it's a $3,000 stock, and so a lot of people hesitate to trade it. But the truth of the matter is, even if you're just buying one share of this or two shares of this, you're still making percentage-wise the same that you would if you deployed that money in a cheaper stock. And it just comes down to understanding the quality of the stock that you're getting into and what kind of a move you're looking to extract out of the market. And so the problem is, like the NASDAQ right now, really we want to see a pullback, because at this point this is actually very poor risk reward. We are testing a decent level of resistance. We've already had a massive move from basically 3,100 to about 35. And so this is, you want to wait. You want to wait for it to pull back and maybe come back and test some lower support before you try to enter, or you want to wait for it to break out, fill that gap, maybe come back and retest, and then start to bounce again. And so kind of a waiting pattern on those two. Same thing with Apple. It just broke out and it's starting to pull back. This is another one that we probably want to wait for a pullback to go ahead and enter. Netflix is going to be a similar case where it's had a massive move already. Google actually consolidating nicely, just like Facebook. And then Tesla's not a FANG stock, but it's another one that I like to follow with these. And it's also had a move. So as you can see, most of the FANG stocks have moved pretty aggressively over the last month, reflecting that rotation back into tech that I mentioned earlier. And the problem is, and you're going to see that same problem with the NASDAQ, is that we've already seen the move, right? And so trying to buy right now, your risk reward is really not that great unless you find stocks that are in a bull flag and maybe we get that momentum breakout and you can continue. And going back, you can see Facebook and Google had that pattern where maybe you can adjust your risk reward based off of the short-term trends. But generally speaking, I think we're better off waiting for a pullback and waiting for a retest of our moving averages in order to get better risk reward entries on those names. Now, we're going to see a very different picture on the Dow Jones. As you can see, the Dow Jones is pulling back. It has lost a very critical test at this point. And so this is either another shakeout that's going to lead to a breakout, or more likely the death of what has been a very long, persistent channel that in my mind had already lost a lot of significance. I went over, I'm not going to go over it this week, but I went over last week how if we go back and take a look, you can see that there's a channel that is, you can extrapolate from what began in November that's kind of taken place all the way up to here. But I don't really think that channel was the relevant indicator of what the Dow Jones was doing. I think the Dow Jones actually went through three stages here. One was a much tighter channel, something like this, and then it broke out and made another tighter channel just above it, and then it had a strong horizontal consolidation. But I know a lot of people look at these and they'll look at this as still connecting. The major pullbacks still held along this trajectory. Right? We had a major pullback in February that held. We had another major one in March that held, and then another one in June, and then more recently in July, and they've all held, and even one back in August. And so we're finally getting to a point where this trajectory is no longer holding, and our pullbacks are no longer stopping at that level. And this isn't a major pullback. It's just we've reached the point where we've just run out of room. And a lot of that is due to the fact that we had such a broad consolidation range that took place between April and July and August. And so we had a nice breakout, and we're coming back, and we are really at do or die time here for the Dow Jones. And the truth is, at this point, it's getting closer to die than do, because we broke that channel. We fell back below 351, although just sort of still holding above this consolidation range. And I could probably put it like this, right? And so this is do or die time, like I said. And the Dow Jones is either going to break back out, and this is going to be another fake out, and we're going to try to ride that channel, maybe on the bottom side of it, but still try to ride this trajectory up, or we're going to fall back into the 330, 340 range, at which point we will most definitely have broken that uptrend, and we'll have entered a more sideways consolidation and a longer term pattern of just chopping around. Oh, Ray, sorry, I didn't notice. You said you own Amazon, October 21 call spread. You paid $450. It's now about $675. Looking for about $9. Great job. You looks like you entered at a good time. I'll go back to Amazon real quick. All right, good job. So your target. So now, Ray, one thing I want to point out here: when you are trading with options, a lot of times your target should not be the price of the option. Your target should be a point on the chart, right? Because this chart is going to move up and down based off of Amazon's price, not necessarily off of the options price. That being said, you've made a good trade, and I understand what you're doing. You're trying to get 2 to 1, right? So you're looking for the 450 to go to 9, and so I can understand that. And we could get a gap fill at some point soon, at which point you'll be closer to it. But I like the trade that you made here. Now here's the thing: 3,300 to 3,310. So, all right. So you're just looking for. You have time. You have time. Clearly, it's in the money by quite a bit. So you're just waiting for that that value to depreciate. Great job. Great job. You have a lot of time to be patient. I wouldn't get nervous about that trade unless it started to fall back below 3,400. At which point, then maybe you need to start thinking about what you want to do. Because you obviously don't want it to come back, but I think you're very safe. It's well above 3,310. So you got a long way to go before you have to worry about it. So I'm assuming that really all you're waiting for is just for a lot of the IV to depreciate as you get closer to October. And you have time for that. So I would say that's fine. Now I do want to point out, like I said, typically when you look at these, you want to look at the chart more than the value of your options. So I don't know that I would want to target 9 as my target as much as I'd want to just watch this chart and make sure that it doesn't, you want the chart to dictate where your trade ends, not necessarily the price of your options. Now that being said, because your trade is so much in the money, you have plenty of time to wait here, because really at this point your trade is a success. It's just a matter of waiting for the value to get better as you get closer to expiration and it loses a lot of the IV that's in it. Great trade. That was actually a really nice trade. Good job. All right, I'm going to go back to the Dow. And like I said, we've got we've reached the point now where the Dow there's something's going to have to happen here, because if we fall back into this level, it could be that this actually starts to drag the S&P 500 and the Nasdaq down with it. With IWM, which we'll get into next, it's been range bound and it's been pretty weak for a while, but it hasn't really affected the overall markets. But I think if the Dow starts to really come down a bit, I don't think it's as strong or as impactful right now. I think the Nasdaq and the S&P 500 are the two indices that I consider the most important when I'm looking at getting a good gauge on the market. I think the Dow Jones, while very widely followed, particularly by the media, with the small amount of components that it has, it could sometimes behave differently from the overall markets because it's just impacted more heavily by its components, and particularly the industries that they're in. I do think that in this case, if we do start to see more weakness come into the Dow, it will likely pull the S&P 500 and the Nasdaq at least down to a spot where they start to consolidate and trade sideways as well, and chop back and forth, and probably kill this new little rally that we've seen over the last month, where we've kind of just drifted up to new all-time highs. And so we're at a spot here that this is very critical. We already broke the 20, and we're already testing the 50-day moving average. The 50-day has held for the most part, although it did break temporarily in June and July as we came down and tested these lower levels. And so there's a good chance that we break it again. And if that's the case, we're going to come down and retest probably all the way down to 336. So if you're nervous about the market and you want the quickest possible tell, or the easiest way to see what's happening, if the Dow Jones breaks below the 50-day, below today's lows basically, and it's going to pull back into this area, and that will likely force the other indices to, at the very least, stall out. I'm not going to say that because the Dow pulls back to 335 that we're going to see major corrections on the Nasdaq and the S&P 500, because it could be that this is just another turn in that rotation between recovery names and tech names, and it could be that this is just money rotating out of the Dow and back into tech. But considering the money already rotated out of the Dow and into tech, if we see even more rotate out, I think that it's probably rotating out of the markets, period, and not into tech. So this is one we want to watch, and we want to see what happens here, and we want to see, as it pulls back, or if it pulls back, how does it affect the Nasdaq in particular. And I think that gives us a much better clue as to what's going to happen with the overall markets. If we see the Nasdaq still rally while the Dow pulls, then, well, it's just rotation. If we see the Dow pull back and the Nasdaq falls with it, then I think it's more indicative of the market wanting to correct a little bit further. And then, of course, if the Dow Jones bounces, well, then I think it's fine, and I think that we're just going to probably get another push back to 356, and maybe even beyond that. Now, key levels, it's very simple. We're at a major key level, and if we lose it, the next key level is way down here at 337. So there's a long way to go here as far as the Dow Jones is concerned, and I do think that if we do break this 50-day moving average, sure, we might find some support around the middle of this and bounce back up, but I think that there's a very good chance that we will eventually head all the way down to 336, even if we get a bounce at the middle of this. And so that will be very important to watch in the near future. And then finally, the last index we have is IWM. And as you can see, very different picture from what we've seen out of the other three. A lot like the Nasdaq, IWM had a very nice trend during the end of last year and the beginning of this year, but since then it's just been chopping back and forth. Been having a lot of trouble getting momentum to break out to new highs, and it's actually pretty amazing that the markets have continued to trend higher, despite the fact that the small caps have not. Now, the small caps are still typically they're the stocks with the least volume. And they're the most volatile, so they don't necessarily need to kind of lead the way forward or back. But more often than not, those are the assets that people look for when they are extremely greedy or bullish. And so the fact that we're not seeing that has led to a market this year that, while it has been a pretty decent trend, has been pretty choppy. So even if we go back and we just take a look at the S&P 500, which has had the cleanest trend right now of all four indices, that weakness that we're seeing in IWM was indicative of a market that is starting to get maybe a little nervous, even if you don't see it on the face value. And that is what leads to these bigger consolidation ranges, despite the fact that we have a clean trend. And that's one thing that's really dictated the way this year has gone. Is this is a misleading chart because the trading, from what I've seen, from the people I've talked to, the traders that I've not just professional traders, but even amateur traders, or just people that just are learning to trade stocks, they've had a much more difficult time this year compared to what we had last year, particularly at the end of well, really any time after COVID, but particularly around the holiday season, where every trade you took was good. In this year, even though if you look at it on the face of things, we've had a market that's trended very steadily, these major stair steps and these big ranges of consolidation have really messed with a lot of traders' minds and have really forced them and chopped them in and out of a lot of trades. And I think a lot of that, not necessarily due to IWM, but is a symptom of what has caused IWM to trade sideways. And that is that we've had a market where traders are still taking advantage of a bull market, but they're starting to get nervous, maybe because the bull market's gone on for so long, maybe because they just think things are overpriced, or maybe just because they're worried about another, the news that comes out with, particularly with COVID and how things continue to spread. And so they've had one foot out the door, and typically that foot that's out the door is the one that's closest to the volatile stocks or the more volatile assets, and that's going to be the small caps. And so they tend to stay away from the risk and gravitate towards the safer stocks, and that's why a lot of the rotation we've seen keeps going back and forth between tech and maybe Dow components and just recovery names. And so this has forced the market to, even though it's been in a strong bull market, to be more choppy than you would expect from it. And at the moment, there's no signs of this ending. Right? We just had a nice breakout above 225, and it looked like maybe we could come up and retest all-time highs. But along with the Dow, we've seen new selling pressure come in over the last couple of days, and we're coming back, and we've fallen right back below, not a major level, but a pretty important level around 225, and we're coming right back and testing the 20 and the 50. Now, it could be that we hold here and we bounce, and unlike the Dow and unlike the S&P 500, IWM does have wiggle room, right? And so this is a little bit more like the NASDAQ, and in that this is not a major spot here where it needs to hold the 20 and the 50, or else it's all she wrote for IWM, and we're heading all the way down to 207 or something of that nature. We can have fluctuation here, and it could be fine. And that's the same as the NASDAQ. We have a lot of room to go back and forth, and there's no real technical damage being done to the chart. However, like I mentioned with the Dow, we don't have a lot of wiggle room here. If we start to break lower than what we are now, well, then it's actually a pretty bad sign from a technical perspective. And it's the same with the Dow. We don't have a lot of wiggle room to pull back further without it having major ramifications on the technical indicators that we have on the chart, right? And so I think in this particular case, I'm not overly concerned with what IWM does next. I think it's more important to see what the Dow and what the S&P 500 do with respect to their charts. And so those are the two that I'm a little bit more vigilant on when I'm looking at what's happening with the price action. With IWM, it's pretty clear. We're either going to bounce at the 20 to 50, or we're going to head down and bounce at the 200, and then try to maybe bounce from there. If we do get a bounce here, it would be really nice to get back to 233 and test all-time highs, and try to catch up to the SPY and the NASDAQ. But if we don't, it's no real major threat at this point. It's just an equity that's just trending sideways. And like I said, I think that this is a symptom of what we're seeing in the overall markets of traders maybe getting a little nervous because we've gone up so far since March of last year. Like I said, if we look at a weekly chart, you see what's happening here. It's understandable when you take a look at where we were in March of last year, right? And what we've done since then. And, we've just reached the point where traders are looking at a spot where they want to take more profits, and they want to make sure that they don't get caught in a move back down to some of these lower levels. Now, it could be that we don't come back to these levels for a long time, or maybe even never, but there's a chance that we do. And even if on IWM, a move from 223 all the way down to 160 would be disastrous. But would it really be anything? If you looked at a stock that did this, that was trading along a major level of resistance here at 158, and then you had a breakout, and you eventually came back and retested that, and then bounced from there, it really wouldn't be the end of the world. It would just be a big breakout that needed time to come back and reconsolidate. And so, as long as, looking at ultra long term, looking at weekly charts, monthly charts, there's a lot of downside here where we're still in a pretty intact bull market. But in the short term, we're looking at just a consolidation range. And like I said, we're the moving averages, the 200 in particular, is really starting to come up to meet price. So we should get a bounce soon. If we lose the 200 and start to turn south, then at that point, we can look at the bearish price action in IWM as something that could start affecting and bleeding into the other areas of the market. So that'll be maybe something we want to watch, is what happens as it tests the 200. But I think from here to next week, the more important charts to look at are the Dow and the S&P 500, because they're the charts that right now are coming up into kind of important levels on their charts. The other two, the Nasdaq and IWM, like I said, we've got wiggle room here, where we can go up or down and not really have any kind of major change in what our price environment is. So that's my take on the four major market indices. I feel like this is a week where I want to be a little bit more cautious. I didn't even recommend any trades this week because, one, we had the holiday, but two, it looks like a week where we're better off just kind of waiting to see how some of these things play out before we go ahead and try to get involved in some new trades as we start to see what happens with our next price environment. Now, I'm going to look real quick at the U.S. dollar. It is actually bouncing, and it's having some impact. I think that this bounce has even had a little bit of an impact on the overall markets. As you can see, we've got a nice 3-day bounce here. We had that wedge that we were looking at. These tend to resolve with pretty quick moves to the upside. And it was interesting because we had that last shakeout as we dropped to 24.70, and then now we've had over the last 2 days a pretty big move right back up. I would expect this to probably continue back up to 25 and possibly to 25.15 and even beyond. So I think that this is a sign of the U.S. dollar, again, really starting to confirm this 24.80 as support on this index. And if we look at it on the Euro-US dollar cross, you can see and again, this is going to be inverse, right, because this is going to be the Euro chart. And you can see that the Euro tried to make a move to get back above a pretty key resistance area, and it failed. So the U.S. dollar bounced strongly, which has led to this decrease in the Euro. And it's coming back. We've got the 50 and the 20 here. So it could be that this stalls the U.S. dollar a bit as the Euro tries to bounce on its moving averages. But what we're seeing here again is the U.S. dollar start to really exert a lot of pressure on the Euro as it tries to establish its own bottom and establish a major resistance level on the Euro. If we look at the U.S. dollar versus the yen, we're going to see the same picture I said last week, which is it's just stuck in neutral. I think the yen has picked up strength at the same time as the U.S. dollar, and that has led to a very neutral chart. I think at this point it's still not a very good trade in either direction. It's getting close to a resistance level where maybe you could look at a short or wait for the breakout, but it's still really just in the middle of a range. And then finally we have the U.S. Canadian, which actually has had some big fluctuation recently. And you can see that U.S. dollar bounce has led to a bounce with the U.S. Canadian. And this is quite interesting because we are not seeing this reflected in the oil chart yet. Typically when you get these big spikes up on the U.S. Canadian, you're going to see an inverse play on the crude oil chart where you get the big drops. And at the moment we are seeing a spike on the U.S. dollar that is not reflected on this yet, which I think is hinting at a probable oil breakdown. But it's a little early to really tell. So again, if we go back to the U.S. Canadian, you can see very big bounce here over the last couple of days, and doing a good job of getting back above a pretty key level around 125. This is another chart that probably has more room to the upside. It could probably make its way all the way back up to 128, maybe even a little bit beyond that. So it's one to watch. And like I said, I think that it will have ramifications on this oil chart. For anyone here that trades oil, now it doesn't have to be crude futures. It could be USO, or it could even just be oil-related names. And as we can see, oil is still stuck in this triangle. Now, in a vacuum, when I see this pattern, I still think that there's another test coming of this descending trend line. But with what I'm seeing out of the U.S. Canadian, I will be watching closely to see what happens as we test, or if we test yesterday's lows in this 20-day moving average. If we start to kind of fall back below that, and then test 66.80, if I see the U.S. Canadian continue to spike higher, this will look like a pretty easy short down to 62. So that'll be something to watch. If you trade commodities or if you're focused on forex trades, as they often influence a lot of other equities, because of course it's the money that countries use, right? And then finally, gold and silver. I still, again, as usual, don't have any interest in it. The U.S. dollar spiked, so gold dropped. This chart is sloppy. There's nothing here that interests me to buy or sell. It's just such a sloppy, messy chart that I just don't want to trade it. Same with silver. You can see what's happening here. It is trying to bottom out, and it did have a nice little breakout before the pullback over the last few days. But generally speaking, I don't like these patterns, and I don't think that these are clean moves that have been very easy to trade or have given us good trading opportunities. And then we are actually seeing big fluctuation in Bitcoin and Ethereum as well. And this actually, when you have this kind of a volatile drop, it's looking right now like we're going to bounce. But typically this is a warning shot that there's more selling to come. So for those of you that maybe follow me into some cryptocurrencies and were able to take advantage of these bounces, I think if we get another bounce back to 50 or around there, you might want to start to scale out and take some profits if you haven't already. If you have, then you should be fine. I am not a fan of completely liquidating cryptocurrency positions, even if they could lose half their value. So I'm not saying that I want to close out everything I own on this, but I do think that we've reached a spot here where if you haven't taken profits or you're still feeling nervous about it, you might want to, I think that we bounce, and if we do, then this is probably a good spot to start looking at taking some profit, because there's a good chance that we have some bigger fluctuation coming here, and we might need to come down and test some lower levels. Now, it could be that this was a one-off event, and we come back up and try to bounce and make a bigger blow-off move higher. But what I'm seeing here, typically when you have big volume events like this, they tend to lead to more fluctuation to the downside, or at the very least sideways. You can see with Bitcoin, we've had a few of these big fluctuations, and if we kind of come back and just, what we do is just erase a lot of what we're seeing here, you can see that as you get these big fluctuations down, you get the bounces, but eventually it turns into a broader range of consolidation, and then eventually you break down. And so it could be that, again, we're starting to get to a spot here where I'm not saying that Bitcoin is going to go all the way back down to 1,000 or to 2,000 or even 3,000. What I'm saying is that or Ethereum, sorry. What I'm saying is that there's a chance that Ethereum is going to really start to see more selling pressure and maybe come back to 2,800 or possibly even down into the 2,500 range, depending on how it behaves. Now, typically, something like this, once we break through it, that should be support. So I think that there's more likely than not downside to about 2,800 rather than below that. But, I'm just saying this is a good warning sign. And, you don't want to panic and sell off that big red candle. We got some nice tweezers developing here, and it could be that we get a nice bounce. But if we do get a bounce to 30, 36, 37, maybe you want to protect yourself a little bit. All right, so that's my take on cryptos, on forex, on commodities, on the stock market. Got nothing else to talk about. So if you guys have a chart you want me to look at, feel free to type it in. If not, we could kind of wrap it up for today. I feel like we are reaching a spot here. I'm seeing selling pressure across the board, whether it be cryptocurrencies, whether it be commodities, or whether it be the stock market. And so it could be that we need to just kind of be patient and be a little bit more cautious over the next week or two, and just try to see exactly what's coming next, just across the board. And I think that some of this could be if the U.S. dollar starts to really put pressure on just across the board. That's one thing we haven't really noticed that a lot with the U.S. dollar because it's been so weak over the last several years. But keep in mind, almost everything we're looking at here, we're looking at these charts. They're all priced in U.S. dollars, right? So uh, there is a mild inverse correlation that is always in place with the U.S. dollar and any equity because obviously the more value the U.S. dollar has, the more pressure it puts on the value of whatever equity is priced in that. And it could be that we're just starting to see the U.S. dollar show signs of bouncing, and it's just putting pressure across the board. Ray, you said you're looking to maybe go long with options on MasterCard. So let's look at MasterCard and see what we're looking at here. All right. We're getting a nice bounce today. Let's take a look. Alright, so here's the chart over the last maybe couple years, right? So let's go ahead and analyze. There's a pretty clear division here, somewhere around 357, right? You can see we've got this spent time here, and then it spent time here, right? Alright, so this is what I like to do, especially with a chart that I haven't really analyzed in a while. And so the first thing I want to do is look at the long-term chart of Amazon and see exactly what is going on here. And so as you can see, the 350 area. Now, obviously, this line is around 358, but just to ballpark it, roughly well, I guess 350 is where we are right now. But yeah, so I guess whatever. The area just above 350, around 360. Has been a change or a major turning point in the conception of value on MasterCard, right? There was a long point here where that was considered to be overpriced, and as you can see throughout 2020 and even the beginning of 2021, that was where it would always find resistance, and then we finally broke out at the start of this year, and that became a good support area. And we just lost that support area, we've come back down, and now we're coming back up to test it. And so my first concern on a trade with MasterCard is, what are you going to do with this level? Is this should probably be the level that you would use as far as where you want to use your strikes if you're going out of the money, right? And what you'd probably want to do is structure a play as to where if it gets back above it, then you're good, but if it gets below it, then you basically have a losing trade, right? And so I think knowing that as we move into a more short-term chart, or more short-term time frame, you can understand exactly what's going on here, and so that's going to give you, I think, a good frame of reference as to when or how you want to enter your trade. If you wanted to enter, if you were looking to enter today, I think that you have yourself a little bit of a trouble spot here, because there's a very good chance that it comes up to 357 and fails and heads right back down. And if that's the case, then your trade's going to lose. So basically, if you enter now, you'd be early. However, once it breaks that, then you'd be late, right? Because then at that point, it's already back in this range. Now, there is plenty of upside all the way back up to 395 if it can get back above and reclaim the 200, the 20, and all that stuff. And so I think at this point, if you're looking at it, so you're thinking maybe a November bull call spread, 350, 355. And I think that those are good strikes to pick because, again, this is such a key level that 355 level certainly has a lot of premium in it. And I think that if it gets above that level, then you are in a very good spot as far as having a good good support level that it probably doesn't fall back below. So I would consider this the kind of trade that has good upside. It probably has a mediocre chance of success, but I think it has good upside and good, I'm assuming, good risk reward by using a vertical spread with those strikes. I'm assuming that it has pretty decent risk reward, and I think that if it can get above this, then you're in a similar spot to Amazon where you can kind of just let it get closer and closer to expiration, and you should be safe if it can get above this area. Now, of course, if it doesn't get above this area, then you have a losing trade, right? And so I think that would be the one issue you have. So you're looking at, let me see, so it's a $5 spread and you're looking to pay about $2. All right, so then risk reward's just 1-to-1, right? Because you're looking at 250 to 5. So yeah, I would watch it and I would see what happens here. Uh, one of the issues we have, one of the issues, like I said, is that we already had a nice bounce today, um, and so it's just going to come down to what happens next as it comes up and bounces into the moving averages. But I do think that there's a good chance we get more bounce here. But I am concerned that we broke below 358. If it was me trading, and it was my if I was trying to make a trade here, I don't think I would be entering here. I'm not going to tell you you're wrong for entering because I understand what you're going for. But me personally, when I see stocks break these major levels, I prefer to wait for them to get back above it. But if it does get back above that, then your risk reward is not going to be the same unless you start to really, come back out to the 370s and 380s. But yeah, so that's my 2 cents on that. I don't think it's the worst trade in the world, but it's not a trade I would take because I don't like, like I said, I think there's a very clear uh, demarcation here. Um, and I think that this is a very clear level that is actually pretty important. And the fact that we lost that and we lost the 200-day and we're below the moving averages is a pretty negative look. And I think maybe at the very least I'd want to see it back above the 20. We can give it some time. One thing that could work in your favor is it may not be ready now, but it could be that it chops back down and gets even lowered back to the 340s and gives you more room for an entry. But I would watch it and see what happens from here. But me personally, I would not be trading right now. I'd be waiting. Um, Either way, I've noticed an improvement in some of your trade selection recently. Uh, Obviously, you and I we have a good history together. I've done a lot of mentoring with you. And I do think that I've noticed a difference in the stocks that at least the ones you're showing me. I don't know what you're not showing me, but at least I'm seeing you not chasing stocks. And I'm hoping you're not marrying, like that you had with that crude oil chart or like your infamous chain nugget chart. I hope you're not having your short-term trades still turn to long-term. But I do some of these trades that you've entered recently. I do like the fact that you're looking at entering at support, and you're not trying to chase stocks that are higher or getting in at really high spots. Still trying to get in early maybe, but at least I noticed that you're not entering stocks at the highs anymore, which is probably a good sign. Okay, and no problem. All right, Ray, good talking to you. Whoever else is in here, thank you for attending, and you know. Feel free to message me. If you don't want to message me on here, you can always message me on Twitter. I'm more than happy to give you guys my takes on charts there as well. Thank you guys for being in here. Those of you that are watching this as a recording, same thing. You can always visit me on Twitter at Stock Darts. Be more than happy to give you my chart request through there as well. Have a good rest of this week, and we'll meet again next Wednesday.